So let me tell you, and I've been at many conferences, it's very, very hard to get attendees back from lunch. And we said, who is the greatest speaker who can actually get attention after lunch? Travis, you were the only name that came up. And so no pressure at all. We're really, really excited to have you. On behalf of Spring Labs, there's literally, and I don't know if you could see the room, there's about 350 people in the room listening intently, taking really, really, really detailed notes. So if we're ready to get started, let me just once again thank you for being here. More importantly, thank you for what you're doing every single day. I think oftentimes, and it came up already on a couple panels, regulators tend to be on the wrong end, right? It's always easy to pick on regulators for doing too much or not enough. I will just say you've been a bright spot at the FDIC. Let's just start with that. At your time in the FDIC, obviously, you're kind of in the minority position at the moment. How have you viewed your role, your position at the FDIC, and how have you taken that with still a focus on pragmatically trying to get things done?
Well, sure. Well, thanks for having me. It's great to be here, even if virtually. So I think in terms of my role on the board, just as by way of background, so the FDIC board has 5 members, as I'm sure a lot of the audience knows. We have the chairman, vice chair, a 3rd independent director, and then 2 outside board members, the head of the CFPB and the head of the OCC. And the way the FDI Act works is you can only have 3 members of any political party. And so that means in practice, the vice chair and the independent director tend to be members of the minority party, and the chair and the other 2 outside board members tend to be members of the majority party. So I think in terms of my role, there's a lot of different elements of it, but I think in terms of things that come before the board, I would kind of put them in 2 categories. There's one category which are things where there's an opportunity to be constructive and try to influence things in a positive direction. And then there's the other category where there are strong disagreements, and a big part of the job is trying to articulate those disagreements and inform the public debate. And I would say that in my time at the FDIC, there's probably been a bit more of the latter than the former, but I think both of those are important parts of the job.
And how do you view, do you see a pathway forward for progress, even from your position versus being on the other side? Meaning, how do you view the need to actually drive the ship versus kind of play follow-on in terms of what's being proposed?
Can you explain that question a little bit more?
Yeah, I would say is like sort of how do you see your role in terms of what you're doing, playing kind of the follow role versus the lead role, and your ability to actually get things done. So obviously, and again, I want to thank you for explaining sort of the makeup, but now where do you think the responsibility on your shoulders falls heavier, where you are today or maybe on the lead role if you were in the majority?
Yeah, so I think for sure in this position, not being obviously the chairman, and especially given the current composition of the board, the chairman controls the agenda. The staff all report up through the chairman. So in this role, my ability to influence the day-to-day policy outcomes is somewhat limited. In my previous job, before I was appointed to the board, I worked in the chairman's office for Chairman McWilliams. So I've kind of seen it from both perspectives. And I think, obviously, when you're in the chairman's office, you have a lot of control over all the words that are written down on the page, all the details of the supervisory approach. When you're not in the chairman's office, when you're sitting in a minority seat, your ability to influence those things is a lot more limited. And so, again, I think in my role, it's sort of trying to be influential and constructive in the areas where I can, and when there are strong disagreements, trying to inform the debate in the hopes that in the future, there are opportunities to take things in a different direction.
Amazing, thank you. And again, exactly what I was trying to get at. You've seen it from both sides, and we appreciated everything you did when you were serving with Chairman McWilliams, and obviously what you're doing today. And so obviously we're here to talk about AI, and we're gonna get to that in a minute, but there has been a tremendous amount of activity coming out of the regulators, all three regulators over the last bunch of months, and kind of wanted to get your take, maybe just for a minute, a bit on each. Most recently being the record-keeping rule, right? And again, not really the main topic of discussion for today, but hard to ignore when you're thinking about banking and fintech, what is being called the Synapse rule or sort of the FBO rules that have come out. What's your take in terms of how the FDIC is positioning itself, and ultimately whether you think it's something that could work moving forward?
Yeah, so look, I think the Synapse bankruptcy is something that we've been following very closely. It's obviously a tragic story for many of the customers who are involved, who have had, in a lot of cases, funds tied up or unable to be accessed for an extended period of time now. I think some of the issues that have arisen there are not new issues. They're things that we at the FDIC have been thinking about for a long time, but they're not necessarily easy problems to solve. I think some of these issues around record keeping are issues that pop up from time to time and have popped up over the course of the FDIC's entire history. There have been instances where banks have failed and didn't have reliable records. And obviously, once you start involving multiple different parties, that can make things more complicated. The proposal that the FDIC board approved, the two key requirements, I think one is that banks would need to maintain records on the end user depositors for specific types of third-party accounts, or a third party would have to hold them if certain criteria are met. And then the second piece of it is that the bank would need to do daily reconciliations or reconciliations at least once a day. I think from my perspective, this is a problem that is worth the FDIC paying some attention to. I think this rule probably needs some additional work. I outlined some of those areas in my statement at the board meeting, but I would strongly encourage robust comments on it. I can't speak for all the members of the board, but certainly in my case, I think very open to feedback. And the spirit of this ultimately is, at least as I see it, I certainly recognize that partnerships are here to stay and are a key piece of the sort of banking and broader financial services landscape. And I think what we're trying to do is mitigate some of these problems, but still create an environment where responsible players can still operate.
And so, again, for all of those that are listening, if you missed it, make sure that you engage and you do comment. The comments make a big difference, not just at the FDIC, but obviously for the public sphere as well, in terms of changing the narrative, specifically here around FBO accounts and how it's going to be regulated. But interestingly, that's a perfect pivot into, not too long ago, all three agencies had put out an RFI and request information. While some people actually may look at what the rule on FBOs and say, you know what, that's not too bad, and maybe it's not completely off base, I think the challenge a lot of us have is really in process and regulatory agencies and how they view operations. Every time a regulatory agency does something or puts something out, it ultimately has an impact on the day-to-day to the people who are trying to operate in the financial services space. And so the question really I have is more about process, right? The RFI is meant to inform regulators about what rules should be made, and yet we're excited about it. I know the American FinTech Council, we're drafting a fairly extensive response to the RFI, but while we're explaining to the regulators what we're doing and how we're doing it, we're already seeing rules drop. And so, number one, I'd love to hear your thoughts on the RFI and the way people should be thinking about it, but number two is, how do you think about the process in terms of, we appreciate the good faith effort to gather the information, but then at least wait till you get the information, have a chance to look at it before you drop rules?
So I totally agree with that, and I've made similar points internally for several months. I think generally the RFI was a helpful thing to do. I think in a perfect world, we probably should have done it a while ago. I think waiting until this summer, I mean, at this point, there's already obviously been a lot of enforcement actions and things like that. So I think doing sort of a more deliberative process to try to inform our policymaking is helpful. I think the idea of dropping the proposed rule before the comment period on the RFI even finished, I think that sent a very poor message to the public. And to be candid, I mean, that's part of the reason why, in my answer to your last question, I was sort of caveating it a little bit by saying, speaking for myself, I'm very interested to hear the comments, because I think putting the proposal out before even getting the comments on the RFI, again, it sort of sends the signal to the public that we're not that interested in the feedback, that this is just sort of an example of the agencies kind of going through the motions. My hope is that that's not going to be the case with the proposal, and that when we get feedback on the proposal, that there will be a willingness from the staff and from the agency and the chairman and the board collectively to be considerate of the feedback that we get. But I think, again, to your point, I think it sends a bad signal, and especially when this also comes on the heels of, over the summer, issuing a proposal on broker deposits at the same board meeting that we issue an RFI on deposits, which again, I think all of this goes sort of, furthers this perception that we're putting all these things out, but are not actually genuinely interested in the feedback.
You beat me to it. Broker deposits, right? And so I think this is where we were going next in terms of, again, broker deposits, we have more of an opinion in that, we think that it's the wrong direction and it's going in the wrong direction. I think it's taking us backwards, right? I think we are actually moving in the right direction to encourage fintech and to encourage the right processes with banks. What do you think is going to happen with broker deposits? I mean, should everybody expect that this is going to move forward as presented, or do you think there's still an opportunity for meaningful change?
So I think that's a great question. For sure, I would encourage robust comments on the proposal. I think this is an area where, as you know, we went through a long and very deliberative process leading up to the 2020 rule, where there was an ANPR, then an NPR, then a final rule, and there was pretty extensive outreach done in addition to the formal comment periods. So I think people at the agency are somewhat familiar with some of the arguments that people will make, but I think it's still helpful to comment. I think in terms of sort of the likelihood of it getting finalized, I think there's a bit of uncertainty in terms of who will be leading the agency next year. Obviously, if the election goes one way, the composition of the board will change in several ways. If Harris wins, there's, of course, a nominee to be chairman, and Chairman Gruberg has announced his intent to resign upon her confirmation. So I think in either event, I mean, it strikes me that to try to finish the broker deposits rule in the next few months seems either impossible or would require an extremely rushed and poor process. So I think there's probably a lot of open questions in terms of where this is all going, but on the substance of it, I think that this is the wrong direction to go for a long list of reasons. You mentioned one of them on fintechs, but I think even at just a much higher level, I think our whole regime on broker deposits is kind of broken at this point, and we have this overarching term called broker deposits that applies to a lot of different types of deposit arrangements that in many cases have very different characteristics from other types of deposit arrangements. And I don't think that is really the presence of an intermediary or the other criteria in the rule are not really the criteria that are most important in evaluating the risk and stability of deposit arrangements.
So thank you again for that. And I know that these issues that we've already discussed are top of mind for nearly everybody in the room, but we're here today to talk about AI, right? And AI is a scary thing because of, and we talked about this earlier today, is sort of what you read in the headlines, right? Or what makes its way to the front pages. And sadly, it's often not positive, right? And so as a regulator, number one, but number two, as somebody who's more pragmatic in their approach, how do you look at AI in terms of, number one, the way companies are utilizing it, and number two, the way agencies are thinking about how to regulate it?
Yeah, sure. So I start by saying, I think maybe just taking a step back, when we think about AI, when we think about innovation, new technology in general, I think we have to be aware that the world is always changing and technology is always moving forward. And that is sort of the beauty and promise of America and our economic system. And obviously it always comes with certain risks and potential downsides, but that's sort of part of the price to pay for progress and growth, et cetera. I think as regulators, as we think about these things, it's important to recognize that there has to be a way for banks to be able to invest in these types of technologies or partner with entities outside the banking sector that are working on these technologies. And if not, otherwise, what we're going to see is either this continual migration of activity outside the banking sector, or the US falling behind as these type of things are developed elsewhere in the world, or just less innovation that's offered to customers in the country. So I think all that being said, it's important for us to promote a regulatory framework that enables these types of things to be tested, experimented with, built, et cetera. I think in terms of how the agencies currently are looking at AI, or at least the FDIC in particular, I mean, I think this is still pretty early days. I think at this point, a lot of the FDIC's approach falls under our existing approach to model risk management. The FDIC has guidance from 2017 that details a lot of the types of things that the FDIC looks at. And so that includes things like model validation and testing, governance and controls, things like that. And so I think a lot of those principles will still apply to AI models the same way they apply to other types of model development. And that includes both things that banks are building in-house, and also sort of some of the expectations around oversight to the extent that banks are purchasing or using these things that are developed by third parties. And then one other piece of it is on the consumer protection side, obviously there's focus on compliance with existing laws and regulations. And so, of course, fair lending is a key part of that.
And Kareem, I don't know if he's still in the room. I mean, he talked about that a lot. The last panel spent a lot of time talking specifically around fair lending. Again, thank you for that. I mean, I think that a lot of the challenge that we have, and I'd be curious to hear your thoughts, is everybody in this room, number one, is trying to serve a consumer in the way the consumer is looking for that access, is looking for that enablement. They're trying, on top of that, to build their businesses to ensure that they can serve that consumer and stay compliant at the same time. It's hard to think, again, you know, broker deposit's a good example, right? Where like we thought we had some clarity. Clarity is always key, and then all of a sudden it feels sometimes like the rug is pulled out. What's the best advice that you can offer to companies who are trying? Obviously, you just mentioned there are existing rules and frameworks and structures to be followed, but is there anything more that they can be doing outside of bringing on more outside counsel, which, by the way, I support, and they're here in the room too, and make sure that you support your local outside counsel. But what can companies be doing?
Yeah. Well, look, I mean, I think that question reflects a few of the challenges. I mean, on the one hand, obviously clarity is always helpful, except when clarity is inconsistent with what people's expectations are. And so sometimes asking for clarity sometimes doesn't always land in the right place. I mean, I think to the extent that the institutions in questions are regulated banks, I mean, I think generally talking to their examiners, talking to their regional offices, I think that tends to be helpful, especially if it's sort of like in the development phase. So if there are things that are helpful to be aware of as you're going through that process. But I do think that at least under the current leadership, I do think that it is a bit of a problem. The lack of clarity that has been provided in a lot of different areas where it would be helpful, and just the slow process of decision making. And so, whereas I think what we want to be able to do is A, provide that clarity, and then B, to the extent that there are questions that arise, we have processes in place to be able to answer those in a timely and useful way. I think too often those types, either clarity is not provided or the processes are not in place to be able to answer things in a timely way.
Again, if it wasn't clear, I'll just say it again. We very much appreciate you and what you bring to the FDIC and kind of the approach that you generally take. And you should never have to worry about an election to think about financial regulation, right? Like, the politics, there's certain places where politics shouldn't exist, and this is probably one of them, so we can continue to find ways to safely serve consumers without stifling innovation. I know there were some questions out in the audience, and there's a mic floating around. Feel free to raise your hand. I'm happy to scream your name. Laurel, that was quick. That was very, very quick. And speaking of outside counsel, Laurel, our good friend who's a sponsor today from Jenner, please, Travis, I don't know, just let us know if you can't hear her.
Thanks, Phil. Appreciate the shout out. Vice Chairman Hill, very nice to have you here. Thank you very much. My question is, what do you think the FDIC could do more of to give financial institutions, banks, and fintech partners comfort that their efforts to increase efficiencies by using AI or other technologies won't be held against them in the course of an exam or other oversight?
Well, I think generally the mechanism to do that is to put out some sort of policy statement that describes what our expectations are, and I think the best process for doing that is to have some sort of process, whether it's an RFI or draft principles or something like that, something where it allows the public and the industry to provide feedback for the FDIC to take back and think about, and then to put out some sort of, as I said, policy statement, guidance, principles, whatever it is, but that provide a clear and transparent description of what the FDIC's expectations are going to be when it comes to moving forward with these types of things in a safe and sound way.
Excellent. Marty? Marty O'Malley from Prosper.
Thank you so much. I'm Marty O'Malley. I'm an assistant general counsel at Prosper, and I'm the chairwoman of the board of directors of the American FinTech Council. I wanted to ask you, so often for a regulator, we're on sort of opposite sides. There's the regulator and the regulated. And I wonder, in the case of AI, if we do not find ourselves somewhat similarly situated, meaning there are so many areas where we're excited about AI, how it can help us, it can improve efficiency, it can routinize tasks, it can lead to better outcomes. And I wonder if the FDIC might also find themselves in that position where AI can help you in your supervisory capacity. And if that's the case, I thought in this particular area, we might have more things in common than we do on opposite sides. And I wonder if you had any thoughts about how we might work together or share ideas or share approaches so that we are working together to produce some of these things that AI can promise.
Yeah, I think that's an interesting question. I think the FDIC has been looking at whether there are ways we can use AI to improve certain aspects of our operations. I think that's been moving relatively slowly and is still sort of in the early days. But I think you're completely right that there probably are a number of similarities between how the FDIC is thinking about it when it comes to sort of that kind of back office type of efficiencies as the industry. And there's probably some parallels to other times in history, like use of email and things like that. I will say, at a more general level, Chairman McWilliams had set up her Office of Innovation, and at the time, the spirit of that was very much the FDIC trying to work with the private sector to try to facilitate technology adoption and thinking about ways technology can solve certain problems. And I think that sort of spirit of finding ways where the regulator and the industry can work together can be helpful. Obviously, the innovation lab has gone in a different direction since then. But I do think just in spirit, that kind of thing can be helpful.
You were very kind there. That it's gone in a different direction or doesn't exist anymore. We're optimistic. We're optimistic in some way, shape, or form. It comes back. Again, we never walk into the FDIC and try to demand. I think for a lot of folks in this room, the goal is to try and work together. And I thought, Marty, it's a great question in that, like, we're really working along a parallel path, right? We all need to kind of match our efforts and bridge the gap that I think all too often exists. Again, not having to wait for an election. By hook or by crook, we're going to have hopefully some new leadership soon. And again, I want to thank you for your efforts. I think there's time for one more question. Annalisa? Sorry, she's all the way over there.
Annalisa Graner at First Bank of the Lake. I'm glad you brought up the Office of Innovation. That was actually the specific question that I had. Do you think there's an opportunity to revisit that concept or the FDI tech concept overall?
I mean, I think the answer to that is definitely yes. You know, when and by whom, I think those are open questions. But I think when Chairman McWilliams left, it was sort of just kind of finding its legs and getting off the ground. And so I think it's unfortunate that that it's, you know, it was sort of repurposed in such a way that is obviously has very different goals. But I would certainly hope that in the future with different leadership that would be sort of revitalized and brought back to life.
Is there anything that we in the industry can do to help support those efforts? It seems like a great opportunity to really bridge the regulator and regulated side, as others had mentioned.
I mean, call the chairman.
Can we tell him you told us? If you want to share his
Sure.
cell phone number, feel free. You could just scream it out.
Thank you.
So let me, again, thank you. I mean, you're seeing it, and I know that Jalapa was here earlier. You're seeing the Novel Activity Supervisory Program at the Fed. You're seeing the Office of Innovation at the OCC. Again, our goal here is to engage, particularly around areas of AI, where we're at the right time. Right now is the time to engage. And 2 years from now, it'll be long overdue and too late. And so again, let me just say on behalf of Spring Labs and everybody here, I just want to thank you for your time, for your energy, for your efforts, not just for being here for today. Everybody here, I mean, I know I'm one of those who tunes into the meetings and reads the follow-up and just, I know it's not easy to be in the room and to have a different opinion and trying to take a different approach that is not ideologically driven, but it's more in the best interests of the regulated, is critically important. So your voice is important to us today, but your voice is important to us all the time. And so thank you, Vice Chairman Travis Hill of the FDIC. Thank you so much for your time.
Well, I appreciate it. Thanks, everyone. Sorry I couldn't be there in person, but thanks for making the technology work.
Thank you.